Imagine if you could prospect for gold without ever leaving your bedroom. Today, you can, except the gold is entirely digital. This is cryptocurrency. It is a type of money that exists only on screens, meaning you will never hold a physical crypto bill or coin in your hand. But the biggest difference from the cash in your wallet is that cryptocurrency operates without any bank, company, or government in charge. Instead of a bank keeping track of everyone's accounts, cryptocurrency relies on a technology called the blockchain. Think of it as a giant public receipt of every transaction ever made, linked together block by block. Because this receipt is shared and verified by thousands of computers all over the world at the same time, nobody can invent fake money or spend the same digital coin twice. So if there is no central bank printing these digital coins, where do they actually come from? They are born directly from the blockchain itself, creating a financial system built on math and transparency instead of a central authority. Welcome to the digital gold rush. But instead of using pickaxes and pans to find value, people are using technology. This process is called crypto mining. It involves computers racing against one another to solve incredibly complex math puzzles. Solving these puzzles is the actual mechanism that verifies and locks in the transactions on the blockchain. The very first computer to solve the puzzle and verify a block of transactions gets a prize, a batch of brand new cryptocurrency. Over the years, the puzzles have gotten so difficult that you can no longer win with a regular laptop. Mining is now done in massive, warehouse-sized facilities filled with specialized servers. To stay ahead in this global competition, these giant server farms run non-stop, requiring tremendous amounts of electricity and cooling. Mining serves two vital purposes. It slowly releases new currency into the world, and it provides the computing power that keeps the entire network secure. Once you actually own some of this digital money, you have to decide how you want to keep it safe. The first option is a hot wallet. This is an app on your smartphone that stores your crypto and stays connected to the internet. The main benefit of a hot wallet is convenience. Because it is always online, you can trade or make purchases instantly. You can even use it at the occasional physical store. Some restaurants or coffee shops will let you scan a code to pay for your lunch with crypto directly from your phone. But that constant connection is also a risk. Anything connected to the internet can be targeted by hackers or scammers trying to find a way into your digital funds. To increase security, many people choose the second option, a cold wallet. A cold wallet is a physical device, like a thumb drive, kept disconnected from the internet. It acts like a vault that remains entirely offline. The trade-off is that it takes effort to use. If you want to spend your money, you have to physically find the device and plug it into a computer first. Because there is no bank to monitor your account, keeping crypto means deciding for yourself whether you prefer the ease of everyday access or the safety of offline storage. By now, you have probably seen social media posts hyping up cryptocurrency as a way to get rich quick. It is true that some early investors made enough money to buy luxury cars, but they are exceptions to the rule. The reality is that the cryptocurrency market is known for extreme volatility, meaning the value of digital coins can change drastically from hour to hour. This graph shows exactly what that extreme volatility looks like. A coin might double in value over the weekend, only to suffer a sudden 40% drop by Tuesday morning. And remember, without a central bank, there is no government safety net to bail you out if the market crashes and your investment disappears. It is a high-risk landscape where prices are driven entirely by supply and demand, and no value is guaranteed. If you are watching this and want to try trading, there are a few legal realities you need to know first. Trusted crypto exchanges follow strict rules. In countries like the US and Canada, you must be at least 18 years old to open an account and trade independently. However, you can team up with a parent or guardian to safely explore a small investment together. When you do, it helps to look past the dream of getting wealthy overnight. The true reward is learning exactly how these decentralized financial markets operate and building your own tech literacy. By figuring out the math, securing a wallet, and weathering market volatility, you are gaining a practical financial education for the digital age.